You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. It is Thursday, October 23rd, 2025. And, well, if you're looking at the global macro picture today, it feels like a huge, high-stakes negotiation happening across, like 3 different tables all at once?
Exactly. You've got currencies kind of consolidating.
Right, and commodities jumping because of these new sanctions.
Mm-hmm. And then this just frenetic pace of diplomacy trying to keep up with all the tech and geopolitical pressures. It's a lot.
It really is.
Yeah.
So our mission today is simple, direct, and frankly essential. We're taking all this crucial info, all the research, the analysis, and we're synthesizing it, boiling it down into one cohesive view so you, the listener, get a fast, comprehensive grasp of what's truly driving things right now, markets and policy.
Yeah, exactly. When we really cut through the noise, the raw material today, it's all about interconnectedness, extreme interconnectedness. These aren't, separate stories happening in isolation.
They're pillars, right?
They are pillars reinforcing a single complex narrative. We've got 4 core pillars we need to unpack for you today. First, that surprising stability in the U.S. dollar versus the deep policy divergence we're seeing in the G10 currencies.
Okay, pillar 1.
Pillar 2, the immediate tangible risk premium being priced into commodities. That's because of those targeted sanctions.
Okay, sanctions impacts.
Then pillar 3 is this kind of duality, this tension between trade diplomacy happening at the same time as highly restrictive technology policy.
Push and pull.
Exactly. And finally, pillar 4. The constant geopolitical flashpoints that, they just underscore everything else.
Okay, let's unpack this, starting with foreign exchange, FX markets. Because the headline, it's almost misleading, isn't it?
A little bit, yeah.
The U.S. dollar is broadly steady, just sort of holding its ground against this constant stream of U.S.-China headlines. Looks calm.
On the surface.
Yeah, exactly.
Mm-hmm.
But dive just one layer deeper into the G10 currencies and you see major tension brewing.
Mm-hmm.
The euro, it's marginally softer today. Mm-hmm. And sterling, sterling's basically treading water right now.
Just holding steady.
Yeah. And why? Because that softer UK inflation print we saw recently, it really took the heat out of any near-term expectations for the Bank of England, the BOE, to hike rates aggressively.
It's the sound of the rate differential engine just sort of stalling out. That's really the core insight here, I think.
Oh, okay.
We're seeing these major G10 currencies experiencing this kind of choppy inaction because central banks are flashing genuinely mixed signals, and that divergence is what traders are grappling with.
Right.
Sterling's inaction is a perfect example. Policy expectations just cooling right off.
And the euro's softness reflects similar caution from the ECB, the European Central Bank.
Absolutely. They are truly flashing mixed signals, especially when you look over at Asia.
Yeah, take China. They seem to be actively signaling managed stability right now. Yeah. The PBoC, the People's Bank of China, they fixed the yuan stronger than expected, 7.0918.
Mm-hmm. Yes, very specific signal.
Very specific. It tells the market they're managing any depreciation expectations, keeping a lid on it.
And what's fascinating here is the sheer policy nuance you see elsewhere. Look at the Bank of Korea, the PBoC.
Right.
They held their base rate at 2.50%, which, looks like a neutral action.
Right.
But they explicitly stated that the door to cuts should remain open.
Ah, okay. So a little bit of dovishness hidden in there?
Exactly. A classic central bank maneuver.
Right.
A dovish signal hiding inside a hold decision.
But are traders really buying that subtlety? I mean, if you're a G10 trader, you're looking at these regional economies, the inflation numbers. You have to wonder if they can really afford to keep that door open for cuts when global conditions are still so uncertain. Feels a bit like spin.
Well, perhaps. But the market still has to acknowledge the intent, Meanwhile, over in Europe, the caution is even more pronounced.
How so?
ECB commentary is stressing that their next move could be in either direction, up or down, total uncertainty.
Hedging their bets.
Completely. And the Swiss National Bank, the SNB, their minutes underscored extreme vigilance regarding these divergent policy paths. They're basically telling the market, look, External policy settings and inflation are the swing factors for the franc now. They can't set policy in a vacuum.
Right, but they're watching everyone else.
They have to.
So, okay, on the surface, we've got this relatively calm dollar, but underneath, almost every other major currency is facing some kind of existential policy tension. Driven by regional economics, external rate moves. It's complicated.
Very.
Let's transition now, because those divergence dynamics, they're clearly driven by regional risks. And those risks, well, they become pretty tangible when we look at the immediate spike in energy prices.
Yeah, good transition.
Moving to commodities. Crude benchmarks are higher today. And here's where that policy tension really meets the trading floor. New U.S. sanctions targeting Russia.
This is a material supply friction event, no doubt about it. And it's the most important short-term driver in the commodity space today, I'd argue. Washington unveiled a new sanctions package aimed directly at Russia's oil sector, specifically naming huge players like Rosneft, Lukoil, and a whole network of their subsidiaries.
So big corporate entities now under extreme risk.
Exactly.
And the immediate market reaction, it tells you this isn't just, diplomatic posturing.
Yeah.
This is real-world consequence hitting compliance departments like right now, today.
That's absolutely critical. We are seeing immediate compliance ripples. For example, major Indian refiners, they're tightening their bill of lading checks for any cargoes arriving post-November.
Okay, explain bill of lading checks quickly for folks not in logistics.
Right. A bill of lading is basically the detailed receipt for the cargo. What's on the ship, where it came from, where it's going. Refiners are now scrutinizing this shipping paperwork really closely.
To make sure they don't accidentally deal with a sanctioned entity.
Precisely, to ensure they won't be exposed. And this complex paperwork process, it's slowing down massive oil shipments. It adds time, cost, and risk.
It's the operational risk that drives the price then.
Yes.
Not just the threat of fines, but the actual logistics getting gummed up.
Exactly. For these refiners, these shippers, the primary fear is having a vessel seized, maybe, or losing access to the international banking system if they mess up the documentation.
Huge consequence.
Massive. Sources are suggesting that some large buyers are actually halting Russian intake entirely, with flows to India potentially falling. Well, towards zero is the quote.
Wow, towards zero.
Yeah. So when you add that much friction, that much uncertainty to the world's supply chains, you embed a significant, probably durable risk premium directly into oil prices.
That is a perfect illustration of real-world risk hitting the market. Okay, quickly shifting to other commodities, precious metals.
Gold's consolidated. After those sharp swings we saw earlier in the week, it's like stable volatility, if that makes sense, finding its footing.
And base metals.
Yeah.
Copper.
Copper's grinding higher, supported by really two main factors. First, those signs of continued U.S.-China dialogue, which we'll definitely get to next. That helps the global risk outlook for industrial metals.
Right. Demand side looks maybe a bit better.
And second, there are some company-specific production headlines suggesting tighter physical supply in the short term as well.
Yeah.
So supply and demand factors both giving it a bit of a lift.
Okay, that sets us up perfectly for, well, what feels like the main act of today's macro narrative, trade and technology policy.
The big one.
This whole area feels like a dual-track strategy right now. It's a remarkable balance, isn't it? Between rapidly increasing pressure on one side and this, frenetic high-level diplomacy on the other.
It really is. Push and pull.
Let's start with the pressure point. The potential expansion of U.S. export controls. Specifically, this thing being dubbed the U.S. software rule.
Yeah, this is potentially huge.
Officials are considering restricting globally produced goods bound for China if, and this is the key part, if they are made with or maybe even just contain U.S.-developed software.
This is truly a tectonic shift. We need to just pause on this for a second to really emphasize the magnitude here.
Okay.
This restriction, it's not focused on physical hardware, like where the chip is fabricated. It's about the digital foundation of manufacturing itself.
So the design tools. Exactly.
Think about the common software used worldwide for chip design, electronic design automation, or even industrial controls. If you use U.S.-developed design software to create a product anywhere in the world.
Even if it's assembled entirely in Asia or Europe.
Right. Even then, that final product could theoretically be barred from being sold into China under this rule.
That breadth of restriction is just immense. It really attempts to create a technological choke point over the entire global supply chain. It's not just about specific chips anymore.
It's not. And the sources confirm the intent is to coordinate this approach with G7 partners.
So building a coalition.
Yes. signaling a desire to create a unified multinational front. They might even announce this approach just to increase pressure, even if full implementation gets delayed. It tells you that technological containment or isolation or whatever you want to call it, it's an enduring strategic priority.
It's dizzying. Because running directly parallel to this highly restrictive policy, we have this incredibly dense schedule of high-level diplomacy.
Carrot and stick.
Totally. Designing global choke points with one hand while discussing major trade deals with the other. How are businesses even supposed to navigate that kind of mixed signal?
Well, it definitely creates uncertainty, but maybe also opportunity for some. Look, we have President Trump scheduled for a long meeting with President Xi in South Korea.
Right. High-level talks.
And the sources suggest potential agreements on things like soybeans, maybe broader trade points could emerge.
Well, there's always a but.
Well, yeah. Trump also reiterated the importance of tariffs and the possibility of taking tariff litigation all the way to the Supreme Court.
Okay, so still playing hardball on tariffs, even while talking deals.
It demonstrates the core leverage remains tariffs, right? Even as they talk about agricultural concessions.
And it's not just the leaders meeting either. The working channels are buzzing globally.
They really are. We know Treasury Secretary Bessent is holding talks with Chinese counterparts right now in Malaysia.
Okay.
And China's Commerce Ministry confirmed Vice Premier Lifeng will also meet U.S. officials in Malaysia. That's happening from October 24th through the 27th, so like right now and into the weekend.
Wow. Lots of activity.
It underscores the complexity. Negotiations are moving simultaneously on multiple fronts, high-level working channels, regional partners. We should also note Taiwan's envoy is claiming a bilateral trade agreement with Washington is near.
Which adds another layer of complexity to the regional trade dynamics.
Absolutely.
So, okay. How is China strategically responding to all this? This intense tech pressure on one side, these simultaneous diplomatic overtures on the other.
Well, the signal from their fourth plenum communique is absolutely critical here, especially for long-term investors and planners.
What did it say?
They approved the next 5-year plan, and it includes an explicit aim for a big increase in technological self-reliance.
Big increase, explicitly stated.
Explicitly stated. That commitment, I think, is the definitive long-term counter-narrative to the U.S. restrictions. They are baking it into official multi-year industrial policy.
So it's not just rhetoric.
Doesn't seem like it.
Yeah.
Now, the communique also promises broader market opening and support for innovation, yes. But that explicit goal of self-reliance confirms that supply chain autonomy and developing domestic technology are now absolutely central to their strategy, regardless of what short-term trade deals get struck in South Korea or Malaysia.
That's a huge long-term shift. Okay, finally, let's look at the critical geopolitical backdrop, which, as you said, underscores everything and remains really intense.
Yeah, still very active.
Back to the Russia-Ukraine front. The U.S. rolled out those extensive sanctions we talked about, focusing heavily on oil revenues, corporate networks.
Which explains the commodity price spike, ties it all together.
Exactly. President Trump also confirmed he canceled a prospective meeting with President Putin, but strategically left the door open for future engagement if it advances peace.
Keeping options open.
Meanwhile, Kyiv maintains that a ceasefire is possible without territorial concessions, even as Moscow's rhetoric seems to have hardened recently. That lack of common ground just makes any resolution seem extremely difficult right now.
And we see this elevated risk profile in other regions, too, highlighting these really sensitive diplomatic windows.
Like where?
Well, in the Middle East, the U.S. Secretary of State Rubio issued a pretty direct warning. Legislative moves in Israel's Knesset toward West Bank annexation. He warned that UCOM could seriously jeopardize the Gaza peace track.
That's a heavy statement. Basically saying long-term territorial lands could undermine short-term peace efforts.
Exactly, underscoring that tension. And then in Northeast Asia, regional security risks remain elevated after North Korea claimed a successful hypersonic missile test.
Right, another flashpoint.
So yeah, every major geopolitical flashpoint seems active, influencing global risk sentiment, which, as we noted, connects directly back to why oil prices are reacting so strongly to things like sanctions.
It really does all connect. If we try to bring this all together, synthesize it for you, the listener.
Yeah, let's try.
The overall landscape today is defined by what? A steady dollar that's masking deep policy divergence underneath.
Right.
Oil prices supported by sanctions-driven supply uncertainty, and those immediate compliance adjustments we discussed.
Real friction there.
Gold consolidating after its recent volatility.
Yeah.
And just a relentless, dense slate of high-level trade and technology diplomacy running from Europe all the way to Asia.
So what does this all mean for you, the listener?
I think the key takeaway is how tightly interlinked trade policy, like that potential expansion of the critical U.S. software rule, is with direct, impactful geopolitical action, like the sanctions on Russian oil.
They're not separate stories at all.
Not at all. They're two sides of the same rapidly evolving macro coin. Your focus probably needs to be on watching the durability of that crude price bid, as those sanctions really filter fully through the supply chains.
And watching FX.
And definitely watching the FX reaction to every subtle policy headline coming out of the BOC, the ECB, the PBoC, all those central banks navigating this tricky path.
That is a perfect summary. And we started this discussion by noting how the sources detail China's explicit goal of a big increase in technological self-reliance,
Right.
which stands directly juxtaposed against those U.S. efforts to restrict technology access via that potential U.S. software rule.
And this really raises the fundamental question we want to leave you with today.
Okay, what's the final thought? If technological self-reliance is now an explicit core long-term goal of one major global power actually articulated in their 5-year plan, what does that fundamentally shift about the very nature of global supply chains, about economic interdependence over, say, the next 5 years? Are we actually witnessing the structural decoupling of technology, regardless of the short-term trade deals being discussed right now in Malaysia and South Korea? That structural shift, that feels like the really big macro dynamic you need to be tracking over the long haul.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.